You have to question the true valuation of the markets now.
Larry Leibowitz of the New York Stock Exchange says there is absolutely no evidence that small investors are being hurt by high-frequency trading. Most of them, he says, don't care about pennies when they're buying and selling stocks, and they're in it for the longer haul.
Look, there's always been charges for as long as trading has existed that people are front-running orders, manipulating stocks. This is nothing new. I think now you add to it the element, the mysterious element of the computer, and it makes people even more mistrustful.
Leibowitz and other proponents of high-frequency, high-speed computer trading say it's performed a valuable function, tripling volume, reducing stock spreads and transaction costs, and providing liquidity to the markets.
Liquidity means that if you want to buy or sell a stock, you could do it right away, and you could do it at a fair price. That's what liquidity means. And without short-term traders, there is no liquidity.
Traders like Manoj Narang say their presence in the market is making it cheaper and easier for everyone to buy and sell stocks. But regulators and lawmakers like Senator Ted Kaufman of Delaware have other concerns.
Clearly, liquidity is way up. But what I say is liquidity is always trumped by transparency and fairness. You can't have fairness if you don't have transparency.
Senator Kaufman, who has both business and engineering degrees, says he's a big fan of technology, but he thinks it's gotten way ahead of financial regulators' ability to monitor it. Right now, it's not even possible to determine for sure who is making high-frequency trades or what they're telling their computers to do.
We don't not know what's going on inside those boxes. There's all types of allegations about what's going on inside there. And basically what can happen is you can have these meltdowns where you can have a computer just go crazy and cause all kinds of problems.
Come on. Which takes us back to the mini crash on May 6th and one of the scariest rides in stock market history when the Dow Industrials plunged 600 points for no apparent reason. Turns out it was triggered when a mutual funds computer dumped $4.1 billion of securities on the market in a 20-minute period, which were then gobbled up by the computers of high-frequency traders and sold almost immediately, sending other computers and traders heading for the exits.
The events of May 6th scared people. I don't think there's any question about that.
SEC Chairman Mary Shapiro had already proposed rule changes before May 6th that would allow regulators to track and tag high-frequency traders, and she is now considering further measures.
Are you comfortable with computers making, 50 to 70% of the trades on Wall Street?
One of the concerns is if one goes wrong, if it operates in an unexpected way, given market conditions, what's the impact of that algorithm that has behaved in an unexpected way on lots of other investors in the marketplace?
And Chairman Shapiro says it's happened since the May 6th crash, after circuit breakers were put in place that automatically halt trading in a stock that moves more than 10% in a 5-minute period.
A number of times that those circuit breakers have been triggered has been because an algorithm operated in a way nobody intended for it to do, causing a stock price to go wildly out of range.
The crash contributed to the crisis in confidence on Wall Street. Since last spring, people have pulled $70 billion out of mutual funds. And the biggest concern of Chairman Shapiro and Senator Kaufman is that average investors have lost faith in the integrity of the system.
Is that correct?
Yes, that's true. Correct. And I'll give you an example. When I was at Wharton, a professor came to me and said, there's a river of wealth that runs through this country. He says a very small number of people know that it exists. Some people can stand on a high hill and see it all from the distance. Some people can get up the edge, and there's other people that are swimming in it. That's the perception American people have about what's going on Wall Street right now. They believe there's a small number of people who are swimming in this river of wealth.
And there are a lot of people out there who think that the stock market is rigged. Rigged in the sense that there are people out there who have advantages, the insiders, right, the big companies.
Yep. And I think that we have to do a better job of, first, obviously making sure it's not the case, but we can't be evasive about it. We have to make changes that make sense, that give people more confidence in the market, add more transparency, and make people feel like this is a place I can trust my retirement savings to.